Hey everybody, this is Ryan Mallory with SharePlanner.com, swing trading the stock market. In today's episode, I'm going to talk about liquidity and volatility and how they relate to each other and whether you should be choosing less liquidity for more volatility. So this email comes from a guy, I've called him Bocephus in the past. That was the name that I assigned people because I don't use their real names in this podcast episode. I choose to give them a fake Florida redneck name so that their identities are concealed because you never know if they do or don't want to be associated with your show. So I take that into the equation. But Bocephus writes, "Hey Ryan, I have written you in the past and used the name Bocephus. I loved your podcast and really appreciate how forthcoming you are about being disciplined and setting rules for your trading. I am competitive bodybuilder and find that there is a lot of principles in bodybuilding that are similar to stock trading, like discipline, learning to track your successes and failures, setting rules, limits, etc. I have been learning about the stock market via courses and podcasts for the past year after getting out of financial hardship. Finally had the chance to open a brokerage account. I use your top-down trading approach for selecting stocks and to use your parameters on market cap, volume, price, etc. I typically look at stocks with at least 500,000 to 750,000 shares of volume, but typically more towards 1 million, so there is adequate liquidity to enter and exit a trade. My questions relate to liquidity and volatility of your stocks you are trading. Do you feel that there is a balance to finding stocks with enough liquidity, but also have substantial volatility? Not sure if this question makes sense, but I have come across charts in my scans that have a high volume, but typically only move 1% or less on a given day. So it feels like that there is an opportunity to enter and exit, but the stock is moving sideways more often than not. Any insight or information would be great. Best wishes and God bless, Bocephus." Okay, Bocephus, this was a good question. There's a lot to actually talk about here because in this particular email, he's getting frustrated with the fact that he can't find stocks that are giving him enough volatility, enough movement. And we're going to debunk some of those concerns that he has. First off, if you notice, he says that he's a bodybuilder, that he has to be very disciplined in his bodybuilding. As you can see, I'm not a bodybuilder, but nonetheless, there's a lot of carryover between bodybuilding and trading. And that's one of the things that I would encourage you is like whatever your expertise is in a field, whether it's construction, whether it's bodybuilding, or maybe it's being a teacher, take the disciplines that those career fields have and learn how you can apply them to your trading. In the case of bodybuilding, yeah, you got to track your successes. You got to look at your failures and you got to try to figure out how you can get better. That discipline can carry over into stock trading. But it's when we forget the disciplines that we use in everyday life. And one of the fields that I notice it the most in is in the medical field. Doctors in general, very disciplined people. Engineers, very disciplined people until they get into the stock market. And then they lose all sense of discipline. I'm not saying that all of them are like that, but I would say a large majority of them are like that because then they start to rely on their smarts and sometimes maybe even egos to assume that just because that they're in a very high level field in their profession, that's going to carry over into trading. It doesn't. Market doesn't care what profession you're in. It does not care. When NVIDIA gaps down, it's not just gapping down for the non-lawyers and the non-doctors and the non-engineers. It's gapping down on everybody. So you want to keep that in mind. Your profession can be a huge benefit to you if you take what makes you successful in one profession and carry that over into your trading, like the discipline, like tracking your successes, like risk management. There's a lot of fields that you have to practice risk management. Bring that over into your stock trading. So a little bit of a comment there that Bocephus made that wasn't necessarily about the podcast itself or a question for the podcast, but wanted me to answer it anyways. Or at least I thought maybe he was wanting me to answer that. But in any case, about the liquidity and volatility, because I do think that there's a lot of good things to talk about here. One, liquidity issues in a stock, that's going to increase your volatility. Why? It's much easier for a stock to be manipulated or to move substantially if there's not a lot of volume. And so liquidity issues are going to increase the volatility, the price swings in the stock. If you don't have a lot of volume, you're going to have a wider bid-ask price. And that becomes a huge issue for getting good quality fills. I mean, I've seen stocks that are like trading at $10 a share. They may only have like 20 or 30,000 shares being traded a day. And they have a bid ask of like 950 and 1030. That's a little bit too much for me. I mean, that's a little bit of an exaggeration. I mean, you don't see that every time, but I've seen really wide stop losses, particularly when the market first opens and they're trying to get the stock up and running. You can have some really wide price spreads. Or if you're hitting a market order at the open, you may see like slippage of 3, 4, 5, 6%, and you don't want to be on the wrong side of that. So no volume, you're going to have an equal, you're going to have a larger bid ask there. And if you have no volume, that means that you're going to have bigger moves, because if they're pinging off of the bid and the ask price, you're going to have much bigger swings, much more volatility. And then those bigger swings are going to lead to making you have to have larger stop losses. And we don't want that either. Larger stop losses, that's going to cause you to have to take on much more risk. And in order to have a good reward risk ratio, let's say you're using 10% stop losses on a very low liquidity stock. Well, then to justify the trade, you need a 20% move out of that stock. Could it do it? Sure. But to be able to consistently do that, I mean, you're setting yourself up for failure if you start to get into a drawdown. Let's say you start getting into a losing streak where you have 5 losing trades that you get stopped out on. Well, then all of a sudden, you got a combined net loss on those 5 trades of 50%, not on your whole portfolio, but just on the last 5 trades. So if you're putting, let's say 20% of your capital on a given trade, and you're taking 10% losses, well, that's about we're talking about what, 2% of your portfolio getting reduced each time you take on a losing trade. You have 5 losing trades in a row. All of a sudden, you're going to find yourself down 10% in your overall portfolio. So that's not good. If you are looking at maybe taking a 3% stop loss or a 4% stop loss, a 5 trade losing streak is going to be radically different. And that's the kind of mindset that you want to have. Drawdowns are brutal on the account. And if you lose 10%, in order to get back up to break even, you got to make 11% from where you're currently at, or from off of your lows. And it gets even worse. If you have a 50% drawdown in your account, you need to double your account or 100% to get back to break even. So we want to avoid these crazy drawdowns. Whereas like if you have a 3% drawdown, I think it's like 3.1 to get back to break even. That's a huge difference, even just from 10%. It's essentially you're having to make up much less ground. So keep the reward risk ratio in mind when you're getting into these volatile stocks, because the ones that have the large bid ask and have low liquidity, they're going to require a much bigger stop loss. And if you find one that's like, well, there's some really good consolidation here and it's breaking out, I still think I could put my stop loss below that. If it's got a large bid ask price, it'll stop you out in a blink of an eye. Even if you do have a good chart in front of you, low liquidity is easily manipulated. One of the other things too is that you open yourself up to massive gaps. So if you look at some of the less liquid stocks out there, one of the things that you'll see on almost all the charts is there's not a lot of times where it's not significantly gapping higher or lower. And so if you find yourself on the wrong side of that, let's say you're long at $10 and all of a sudden it gets down to $8, and maybe even it comes back and gets back to break even before the end of the day. But if it gaps down to $8 and it stops you out, well, that kind of sucks. That's not going to get you anywhere. I mean, that's a brutal loss right there. And just because you had a stop loss at 4 or 5%, if it gaps down 20%, you're not getting out for 4 or 5%. And I've seen that a lot more lately, that people think just because they have the stop loss and that it's going to be honored there. No, not if there's nobody willing to buy your stock when it's getting stopped out at that price. That's why liquidity is important, because you want to make sure that there's going to be buyers to step in at that stop loss. And if you get a significant gap down, or if a stock is susceptible to major gaps to the downside, and you see a history of it, then that stop loss is going to be worthless if it's opening up 10, 15% below it. So all these things, I just want you to keep it in mind. I'm not saying that there's never an instance where there's not a trading strategy out there that can't benefit from some of these stocks, but by and large, it's a losing game. So we know that the volatility equals bigger risk. Makes your trades a lot harder to manage too. Like I said, with the gaps, but even just the day-to-day swings. And you got to think too about what does that do to your emotional health when you're seeing a stock move 5, 6% You find yourself up 6%, you're like, oh man, this is awesome. And then before you know it, by the end of the day, you're down 1%. And it's so defeating when you see those, when you experience those highs and lows during the course of a trading day. You really want to avoid that kind of emotional damage at all costs. So what I want you to think about on trading, not about whether or not a stock is moving 1% or less during the day. That's what technical analysis is for. The better you get at technical analysis, when you have like a tight coiling of where you get 1%, 1%, 1% days where it's or less, and it's just not moving, there's really no reason to be in it. What you're wanting to do is play a bounce or play a breakout. There's really two major plays in swing trading: breakouts and bounces. So it's either bouncing off of a support or breaking through a resistance. You really don't want a lot of that in between where it's not really doing anything at all. You want to make sure that it's coming off of a support level and you're getting that continuation to the upside. That's where, following a big pullback, you get a substantial bounce. Most of your gains, if you look at most of your charts, takes place when there is a significant bounce off of a key support level. And likewise, breakouts can lead to substantial improvements too. You look at Meta, I mean, it's on a 13-day winning streak, the longest in its stock's history. And that came following a massive breakout of a triangle pattern, a continuation triangle. And so it's continued to pile on the gains ever since that breakout. And it's been able to do it in a substantial way. But before that, it was actually coiling. So you don't want to really get in when a stock is just getting wound up tight. You want to get in when there's a substantial move, whether it's a break of resistance or a hold of support that leads to a bounce. Otherwise, you're just kind of stuck in no man's land. You don't want to be trading in no man's land where there's just nothing to really take advantage of. You're just waiting for something to happen, and oftentimes it'll result in an outcome that you don't really desire. So keep the reward risk in mind. Also, what I want you to keep in mind is swingtradingthestockmarket.com. Yes, that'll take you to my Share Planner offerings. You can become part of the Share Planner trading block, where you'll be part of where you get all my trades each and every day. Plus, on top of that, you'll get my daily watch list of the stocks that I'm looking to make trades for. And I will send out videos each day for mega cap updates and stock market updates overall. I'll alternate those each day. Plus, each day you're going to get a watch list review. So I'm going to go over all the stocks that I covered that day in the watch list, let you know how they're doing, what kind of actions I'm looking to take. Plus, my bullish and bearish master watch list each week. I send that all out on the trading block. It's definitely worth checking out. But again, bringing it back to reward risk. Let's say for the sake of things, in order to trade stocks that have liquidity, the only things that move are only like in increments of 1%. Now, I'm not saying that's how it is in the stock market, but I'm just saying for example purposes. All the liquid stocks, they never really move more than 1%. Okay. But if you can still make 2-to-1 reward risk ratio, let's say that your average stop loss is 1% and your average gain is 2%. Meaning that if you get in a stock at $100 a share, you have a price target of about $102, a stop loss at $99 because the stocks don't move that much. Can you not do really well in the stock market if you're constantly doubling the amount that you're risking on every trade and you have at least like a 50% winning rate? Absolutely. You can do phenomenally well. And the same can be said about whether it's a 6% average gain versus an average 3% loss. What you're really trying to look for is making sure that your gains are outpacing your losses and not getting caught up on how much you're making on an individual trade. It's like, well, I want to make 15, 20% on each one of my trades. That's great. But if you're risking 13% to do it, that's not nearly as good of a winning strategy as somebody who's risking 5% to make 10% or 3% to make 6%. In fact, the 3%, risking 3% to make 10% is way better than somebody who's risking 14% to make 15%. You're dealing with a lot longer swings, or a lot bigger swings in your trades, and you're staying in the stock for much longer than you need to because it takes a lot longer to get stopped out. So in order to find out if you're going to be a loser on the trade, and I'm not saying that derogatory or anything, but if you're going to find out if it's going to be a losing trade or not, you want to find out that relatively quickly. I don't want to be stuck in a losing trade for months on end. I want to lose fast, win slow. I want to stay in my winning trades as long as possible. That's great. I love it when I stay in a winning trade for more than a month. I think that is like the hallmark of success because that means that stock has been running for me in my favor for a while. I've probably taken some profits along the way as well, but I'm letting that winner run. But what I don't like is when I start seeing a losing trade carrying on for like 2 weeks. Holy cow, I do not need that in my life, because that just means I'm tying up capital in something that's losing me money. I would rather lose that money fast and be able to deploy it into something else. So focus on the reward to risk ratio, not on the volatility of the trade. And you are correct, Bocephus. I try to say that without laughing. But Bocephus is right, though. There's more volatility in stocks when you're trading stocks that are less liquid, because the bid and ask price isn't going to be that great. There's less people that are interested. And that's another thing that I would highlight. Why are these stocks illiquid? It's because investors aren't interested in them. The ones that they're interested in, think about Apple. That's a very liquid stock. Why? Because everybody's interested in Apple. Same thing about NVIDIA or Microsoft. Or if you can go down to like other stocks like Wayfair or Reddit, people are interested in those things. But you can go into stocks that have like 6, letter symbols to them, and they trade, 500 or 600 shares a day. Man, you're going in for a roller coaster there. And a lot of people will trade those. A lot of people will trade without ever thinking about liquidity in a stock. That's why in my scans, I always have liquidity parameters. I don't want to see anything that has low liquidity showing up in my scans. And then fall back on technical analysis. Just because there's liquidity in a stock or a good amount of liquidity doesn't mean that it's going to be a boring trade. The boring trades are really, in my opinions, the ones that tie me up in a losing trade for an extended period of time. If I have a runner that's only going to make me ultimately like 10% over the course of a couple months, I'm fine with that. Why? Because one, that's a portion of my capital, but two, that stock is running successfully to the upside, and I'm managing my trade. When it finally starts to move against me, I'll get out. But I wouldn't get caught up, because also I would say this: when you're getting caught up on the volatility, you're probably dollar watching, and dollar watching invokes emotions because you're equating the dollars made or lost on a trade to something that's important to you, and the market doesn't care what's important to you. You're equating it to your kids' college tuition that you need to pay at the end of the month, or the mortgage that's due at the first of the month, or perhaps it's a vacation that your wife or your husband is dying for you to book, and you're trying to get that out of the market. When you start to do that, you're inserting emotions and variables into the market doesn't care about. So don't be dollar watching. Don't be dollar watching at all. If you enjoyed this podcast episode, I would encourage you to like and subscribe if you're listening to it on YouTube. If you're listening to me on Spotify, Apple, or the tons of other podcast platforms out there, make sure to leave me a 5-star review. That really does mean the world to me. Check out swingtradingthestockmarket.com and let me know, what are you struggling with as a trader? Send me your emails. I'm the only one that reads them. Ryan@shareplanner.com. I'll read them. I'll make an episode out of them. I'll give you a good Florida name, and we'll be able to learn from each other in the process. Tell me your stories. Tell me your struggles. I'm looking forward to hearing from you. Thank you, guys, and God bless.